Hi, folks. Navy Dowdy here in the Chicago area, in the Midwest, in the great United States. The question this week for this week's tax tip is, can we reach back into last year and affect last year's taxes? Still at this late date. By this late date, I'm recording this on the Ides of March, March 15th. And the answer naturally is, of course you can. There's always something you can do. Choices are pretty limited at this late date, however. At this time of the year, many people who are getting a refund have already filed their tax return, and it leaves the remaining majority of folks who, despite having withholdings, are still going to owe additional taxes. So we talk a great deal about tax planning and changing behaviors to achieve a better outcome in the future, but many are faced right now with a tax bill for last year. So what can be done? Anything? And of course, as I said, the answer is yes. There's always something that can be done. It's actually pretty easy for most people to substantially reduce their tax liability that they are facing simply by opening a prior year IRA. It's one of the very few ways the IRS allows you to retroactively affect your taxes. There were some added ones in the big tax act, Secure Act 2, they call it, from passed in December. A little more obscure, and if you need that, get with your tax planner. But what if you don't have the cash for an IRA? You can turn assets that you already own into a prior year IRA with some simple paperwork, with nothing needing to be bought or sold. So let me give you an example. John and Mary are facing a $3,900 tax bill even after taking $12,000 being withheld from their W-2 form. They have a daughter in college, so there's no cash in the bank to put into an IRA or even to pay the $3,900 tax bill. They do, however, have a brokerage account with a local broker with a few stocks that they've purchased over the years. They can simply do an online IRA application. Now, you have to make sure it's an application for the previous year, not the current year. And when they have the account numbers, the new account numbers, they can then do a transfer in kind for any of the stocks they have from their regular brokerage account into their new IRA without selling them. In a sense, they're just taking it out of their left pocket and putting it into their right pocket. The outcome, however, ta-da, is a $13,000 or $14,000 IRA deduction, and they still own the same stocks. Now, one thing to consider is that they've now locked up that stock until age 59 and a half. But another consideration is that stocks have a better tax rate when they're sold if they're held for a year, called the capital gains tax, which is lower than the ordinary income tax that they will pay when they take the money out of the IRA in the future. Now, suitability of IRAs versus non-qualified stocks is not really the point of this post. Anybody making any decisions about finance should seek professional advice, which is the point. If your tax preparer says it's bad news and doesn't offer at least some solutions, then you should go to a tax planner and work through your options. But just because there's no cash in your checkbook doesn't mean that you should think that nothing can be done. I'm Navy Dowdy, and remember, less tax, better life.